Are you ready to take control of your family legacy and financial future? Howard Kaye and his experienced team have been helping families and business owners coast to coast with their most important financial decisions for more than 60 years. They have the proven strategies you need to grow and protect your wealth and family legacy for generations to come. Whether you're focused on wealth creation strategies, planning for guaranteed lifetime income, selling an existing life insurance policy that's no longer needed or wanted, or simply leaving a financial legacy for future generations, Howard Kaye has the resources to guide you every step of the way. Howard and the team at Howard Kaye Insurance Agency LLC want you to live a rich life that's well planned and tailored to your dreams. Live Rich, Die Rich starts now.
Legislation is always affecting the retirement landscape, and it could impact how your money is taxed. How can you potentially avoid unnecessary taxation in retirement while also growing your nest egg? Today, you'll hear about an exciting strategy that could provide a solution. Welcome to the program, everyone. I'm Amy Sharp, and joining me, Howard Kaye and Tony Scuderi with Howard Kaye Insurance Agency. And welcome, gentlemen.
Thank you for having us.
All right.
Appreciate it.
Ready for another show?
Absolutely.
Okay. Well, Secure Act and Secure Act 2.0. I'm sure that many of our viewers have heard about that over the last few years, the legislation that has come out of that. What do we need to know? What did we learn from that?
Well, there's been a lot of changes for that retiree with respect to required minimum distributions, the RMDs that are being taken out. And this is something that Tony really focuses on when we're discussing the annuity income.
Correct.
And what we haven't touched on in any of the shows has really talked about the qualified money, which is where this really pertains to.
Correct.
And how we utilize qualified money with the annuities as well.
Sure, and I can address that. So when people think of the term annuity, they don't always differentiate between qualified monies like IRA money or 401k monies, 403b monies, which is tax qualified, and non-qualified after-tax money. Both types of money can be placed into an annuity, either to accumulate at interest or to create a lifetime income or lifetime joint income. It's simply a checkbox on the annuity application, which changes the tax classification of that annuity. And of course, what's important is that we don't mix and mingle the two types. So you can't combine IRA money with non-IRA money, but you can establish a separate annuity. One policyholder or contract holder can have an IRA annuity and a series of non-IRA annuities. With the Secure Act, a couple of things have changed that are pretty important. The RMD age has changed. That's now changed a couple of times, first with the Secure Act and now again with Secure 2.0. So that currently is now age 73. That's actually going to be going up to age 75 ultimately.
One more time, at least.
That's right, one more time. And then in addition, you have changes to the inherited IRA rules and how that can be treated. You know, in the past, you used to be able to stretch the IRA that you received from your parents for your lifetime based on your life expectancy and take your own RMD over time, but it was a very minimal amount because it was based on your life expectancy. The IRS essentially got tired of waiting so long for their money and basically said, you can't do that anymore. So what's going to wind up happening is you're going to have to take the money over a 10-year period in almost all cases, and that means taking the entirety of the money out by the end of year 10. And in cases where the person who passed was already of RMD age, then that inherited IRA would require distributions or RMDs to that beneficiary in years 1 through 9, and then by year 10, all of that money must be taken out of the IRA at that point. The IRS is basically wanting its revenue a little bit sooner. But whether it's a rollover of an IRA, a 403b, a 401k, it's very important it's handled properly so you don't have a tax problem. So we encourage clients when they bring their documents, bring their statements with you. We want to make sure we don't make any errors on the types of classification of these IRAs and these rollovers and these annuities, so we can do it properly and establish the right plans.
Yeah, so many of our viewers caught what you just said, that tax liability. You know, you want to pass it on to your loved ones and not leave them with this huge tax bill. There's that
Right.
point.
Absolutely. And that's where we show people how to, again, use life insurance to offset those taxes that are going to be. Now, we've done things with, previously I've talked about an IRA maximization, but there are annuity maximization programs. And again, that's focusing on somebody's annuity. So if somebody knows that they are going to, and let's say the annuity is within their IRA, so it's qualified money, and they know, for example, there's $500,000 there, and the idea is that while they'll be taking income, if they leave it to the heirs, there's only so much money that they're going to get because of taxes. This is where, for people that don't need that income, they take it, pay the tax, and use the remains of that income to buy life insurance for an amount that not only covers the ultimate tax from that annuity, but might actually create much more money than was already instituted in the annuity. And one thing, and Tony, maybe you'll even elaborate on this, but for people that are listening, when we're talking about putting an annuity into a retirement plan, I grew up in the era that any tax person would have said, you never put an annuity into an IRA, a retirement plan. And their reason was because you don't put a tax shelter into a tax shelter. It's already tax deferred, so why would you put an annuity? Well, yes, that may be one of the benefits of an annuity, that it's tax deferred. But that's not really the only reason people are buying it. They're buying it because of the income potential that it can provide. They're buying it because of certain protections. They're buying it because they like the fact that they can't lose and they still have upside potential if they're looking to accumulate. So even though, yes, I understand you don't need a tax shelter and a tax shelter, there are benefits to this annuity for being in a retirement plan.
Absolutely. And the reality is that most of the plans that clients have their IRA money in already oftentimes are stock-based or bond-based. When the money runs out, there's no more income, plain and simple. The assets are not protected from creditors or lawsuit. They're totally vulnerable, as is money in the bank if you get sued. In addition, there usually isn't any sort of a health care multiplier or long-term care benefit. All of these things are now available in annuities, including joint lifetime income. So there is a plethora of reasons why people can place and should place some of their IRA money into an annuity. Now, that doesn't mean they don't maintain outside assets in their current investment portfolio. That's okay, but annuities are definitely a consideration.
All right, thank you so much. We're off to a great start. And up next, if you think life insurance has no place in a retirement plan, you might want to think again. Howard and Tony continue to explain life insurance to us and how working it into your overall plan could be a difference maker in a 21st century retirement and estate plan. Stay tuned.
Everybody needs a plan. If Carol's ever going to retire, she needs a plan. So does Bob, if he ever wants to catch a break. Jim and Susan, they need a plan to keep the beat going. And Puddles over there, yeah, he's going to need a plan too. You? Yeah, you probably need a plan. Whoever you are, whatever you do, you can use a plan for retirement. We can help.
Welcome back to the show, everyone. I'm Amy Sharp, joined once again by Howard Kaye and Tony Scuderi of Howard Kaye Insurance Agency. A lot of us nearing retirement think we don't need life insurance any longer, and that's why we have these guys here, because we want to get your view on this. Of course, you have a thought about this.
I do, and you're right. Many people don't think they need it, and they don't, because I find that other than you being young, having a new spouse, a new child or family, you buy life insurance for protection. No different than you buy home insurance, car insurance, anything else. It's a must, and you're irresponsible if you don't protect your family. But you've reached a stage in life where you're now talking and focused on retirement. Your children are out, and let's say they're making their own way, which is terrific. Do you need life insurance? No. But what I like to say to people, do you want life insurance for the benefits that it provides? So we switched it from a need to a want. Number two, why would somebody want insurance? Well, we've gone through so many different use cases of over the weeks of how life insurance can benefit a family. Maybe you want to leave more to charity without disrupting what you leave to your family. So using life insurance is an easy way to accomplish that. Maybe you want to focus on really enjoying the remaining years of your life, and you don't want to think about, am I digging into my children's inheritance? So by utilizing a life insurance policy, it allows you to have that comfort knowing that your kids are going to get exactly what you want them to, and you're free to go spend the remaining of it. Maybe the estate has grown to a very large number, and you know that you're subject to very large estate taxes. You don't want your kids to lose that money to Uncle Sam. Well, in that case, it's life insurance. Now, in the reverse, just to put life insurance in perspective, when people say, yes, but what if the tax laws change? And at one point, I had a certain tax liability that we bought life insurance for, and no longer in the future do I have that same liability. Well, I love to say to people with a little tongue-in-cheek, although it's not tongue-in-cheek, it's that if the life insurance was good enough to buy to take care of Uncle Sam, if Uncle Sam is not taking it anymore, your money, then I guess the life insurance is good enough to leave extra money to your children. So again, a want, not a need, but a very important want for those people that know exactly what they're trying to accomplish.
Not to mention, Howard, for those folks who find themselves in a situation where they have adequate assets or adequate life insurance, the tax law changes, their tax exposure changes, their family situation changes. There's always, for those folks who are over age 70 and 75, an exit strategy potentially in the form of a life settlement, selling your life insurance policy. If it's become burdensome or they otherwise are looking to sell the policy and surrender it to the insurance carrier, a life settlement may give them 2, 3, 4 times the cash surrender value where it's appropriate.
Absolutely.
What about someone who just says, it's just another product, and at any age maybe?
Listen, true, people can say that. People will, as I grew up in this industry, I'd always hear about, oh, well, that's just another way for the insurance companies to make money. And, the truth is that nobody who has ever received a check from a life insurance company has sent it back. In fact, I'll tell you, years ago, a close friend of mine, when I moved to Florida, had seen different shows that I had done on television. And he called me up one day and he says, I don't believe in life insurance. Is there any real truth to what you're saying here? And I said to him, well, what do you mean you don't believe in it? I mean, you buy life insurance, it creates a certain amount of money, it pays off when the person passes away. He says to me, should we be buying life insurance? And my mother, because my brother and I would be interested, his parents didn't really share with them what they would be receiving one day. So we bought insurance. Anyway, the father had passed, and then a few years later, the mother had passed, and I think they had the insurance for no more than 9 or 10 years. And while that certainly wasn't what they were looking for, because they really thought their parents were living much longer, wow, what a windfall that they had never expected. But he called me up when he received a check in the mailbox, and he received a check for $6 million. And he called me up and he said to me, I just have to tell you something. Whatever I had said to you about life insurance in the past,
I take that back.
He said, I just didn't understand it because I have never in my life opened up an envelope and received a lump sum of $6 million. Regardless of how much money I have, this will impact my life tremendously. So, for those who want to say it's just a product, let us educate you. Let us show you why it's so important, what it can do for you, and if you choose not to participate, then that's you, but somebody else is going to see the benefits of what life insurance provides.
The flexibility, Amy, of life insurance, the versatility is almost unsurpassed. The number of business applications, buy-sell insurance, key person coverage, executive bonus plans, estate planning, portfolio insurance. Clients are out there investing. Money's at risk in the markets. And if they can have life insurance backing up their investment strategy, they may not worry so much if the investments don't do so well, because ultimately that money is going to come to their family income and estate tax free if it's properly structured. So the versatility of life insurance is incredible. We need to educate clients about that. And as I said earlier in shows, it's about relationship and education, and that's what we're here to provide.
And you know, Tony just mentioned about key man insurance. Just so you know what this means, I have life insurance on every one of my employees in my office, including Tony, because if God forbid something happened to Tony and he wasn't here, that would greatly affect my business. I rely on him for so much. So, not that the money replaces you, Tony, but it certainly will help for a while.
Disclaimer. I'm glad we got that in there.
Ease the pain.
I love it. All right, thank you so much. Straight ahead, Howard shares another exciting strategy with you, and that's next in Dollars and Cents. And still to come, Howard and Tony will be here to answer some of your questions. Stay with us.
How much do you have saved for retirement? Now, cut that number in half. That's the impact inflation could have. Think about what that could do to your lifestyle and spending power in retirement. Inflation is on the rise. How can you protect your retirement dreams? Start by getting this free guide to understand inflation and the 5 easy steps you can take to help keep it from downgrading your retirement. You can't stop inflation, but if you act now, you may be able to minimize its impact on your retirement. Get your free copy now.
In today's Dollars and Cents, Howard explains how to convert your Social Security income into tax-free millions. Howard?
Thank you, Amy. Today on Dollars and Cents, how to turn Social Security income into millions of dollars on a tax-free basis. Is it possible? Well, as I've said in previous shows, many of the concepts, most all of them, strategies that we've created, were really created as a result of my own family utilizing these things that my father implemented many years ago. And this Social Security idea is no different. Let me share this with you. It was a cute story, but the outcome was tremendous and actually done. We were on our way many years ago to Naples to conduct a seminar workshop. And on the way there, I'm driving, of course, and my father is going through his mail and opens up an envelope, and it's his first Social Security check. And he looks at me and says, "Oh my God, can you believe this? This is amazing. I'm getting Social Security finally from the government." I said, "So Dad, how much is it?" He says, "Well, it amounts to about $30,000 a year for Mother and I." I'm like, "That's terrific." He said, "But truthfully, son, we don't need this money. What am I going to do with it?" As a good son, what do you think I said? "Of course, Dad, I'll take the money." And of course, he didn't take too kindly to that. He says, "I'll tell you what I'm going to do with this money because I figured out a way to put it to really good use." I said, "What's that?" He said, "Son, understand one thing. The $30,000 that Mother and I are going to receive in Social Security have taxes associated with them. So we really are getting $20,000 a year after we pay income tax. And $20,000 a year isn't going to change our lifestyle. So rather than taking the $20,000 a year, I thought of taking the $30,000 that came in the check and gifting that to our charity, our favorite charity, or our own donor advised fund, or any charitable organization. And by doing that, I get a tax deduction. And we have enough income that I won't have to pay tax on this money because it will be offset from the deduction and the other income taxes. I said, "Okay, now what?" He says, "Well, based on our ages, this $30,000 a year that I'm getting full use of by gifting it to the charitable organization can now purchase a $2 million life insurance policy on Mother and I." And I said, "Well, that sounds terrific, Dad." He says, "Terrific? Are you kidding me? This is incredible." Basically, I took a $30,000 Social Security income check that Mother and I don't need, that really would have been worth $20,000 after taxes, and instead turned it into $2 million for the benefit of charity. Well, that's all he had to say as far as thinking about the idea. He implemented it that week when we came home from Naples, and I can't tell you how much money by way of life insurance that various charitable organizations have received as a result of just little ideas like that. Because again, we try to think outside of the box. These are not your typical strategies, but but it just takes one person to come up with an idea, that light bulb goes off, and you realize, wait a minute, this is found money. In other people's examples, they look at it like, I didn't get Social Security income from the government. What I got was a life insurance policy for the benefit of charity. Now, if charity is not your cup of tea, and you say, is there a way that I can optimize this Social Security income for the benefit of my children? Well, the answer is yes. If my parents had said, son, we have to pay the income tax on that $30,000, which means we have $20,000 left over, and we want to buy life insurance on Mother and I for the benefit of you and your brother and sister, in that case, we would be able to buy roughly $1.3 million of insurance. But is that incredible? Did anybody ever think in terms that their Social Security income could create ultimately $1.3 million completely tax-free for the benefit of their children? So the choice is yours. $2 million for the benefit of charity, $1.3 million for the benefit of your children. But the point is, Social Security income can do tremendous things for those of you who don't need it. Ladies and gentlemen, another tremendous strategy here on Dollars and Cents.
Still to come, we'll hear directly from you in our Q&A section. Stay with us.
Our generation has always believed a hard day's work is its own reward. So for some of us, it's hard to turn off that work switch come retirement. But imagine what can happen when that work switch becomes a life switch. Then you realize every day in retirement is its own reward. We can help you flip the switch to make work days become life days.
And welcome back, everyone. Here again with Howard and Tony, and it's time to get to some of your questions. And this is a favorite segment for you guys, I know.
Absolutely.
Are you ready?
Yes.
Okay, here we go. This one is from Grant in Boca Raton. I've been hearing a lot about Roth IRAs and Roth conversions. A friend of mine that visited your office said that you may have a better way to produce tax-free wealth. Can you tell me more about it?
Okay, well, you know, there are some issues with the Roth IRA, and they're very popular because, of course, the difference between a regular IRA and a Roth IRA is that ultimately distributions from a Roth IRA are income tax-free. And then, of course, the conversion opportunity that clients have to convert a traditional IRA to a Roth IRA has been very popular over the years. But the reality is there's a cost associated with it because it does accelerate a tax bill. When you do the conversion, taxes are due at that time. And the reason it's advantageous is because ultimately from that point forward, the money can grow without income taxes. However, it's not the perfect solution in all cases. Howard has talked about in some of our earlier shows the fact that you can maximize your IRA or 401k with our IRA maximization strategy, which involves taking taxable distributions from your IRA, which you can control what that distribution size is depending on what type of an estate you're trying to create. And you can take that money and gift it into, for example, an irrevocable life insurance trust that's going to create a very large tax-free death benefit. And ultimately what that can do, for example, if you're taking out your RMD or, for example, just the 5% interest that you earn on that sum of money, you can create quite a bit of money. We had a client not too long ago that had a $250,000 annual RMD, which troubled him greatly because he realized this is a tremendous amount of money that I have to draw out each year. And he said, Tony, I frankly don't know what to do with this kind of money every year. It's a burden for me every year. I lose sleep over it. What can you do? Well, by taking out that $250,000, paying the tax that was due on it, and then taking the remainder, we're able to create $14 million of insurance on his wife's life, not his because his health was failing. And that, in his situation, with the size of his estate, was the equivalent of creating $45 million because his $45 million would ultimately only be worth $14 million net after all his income and estate taxes. So we were able to take that distribution and instead of doing a Roth conversion with a huge tax bill up front, create an ultimate amount of tax-free assets that was far greater and very impactful.
And made him feel so much better.
So much better.
Okay, here's another question for you. This one's from Andrea in Palm Springs. I'm 58 and my husband is 60. We are currently shopping long-term care insurance, but really struggling since we know we need additional life insurance as well. What should we do?
Great question. The long-term care market, we've touched on it in some shows previously. So the life insurance companies created a program where they add a rider to a life insurance policy. And this is exactly what someone like her would be perfect for, her and her husband. Because let's just say they needed $1 million of life insurance. They could buy that life insurance policy, and based, I think, on what you said their ages were, let's say it was somewhere in the neighborhood of $10,000 a year. If they had to pay $10,000 a year, they could add to it a long-term care rider where each of them would be able to have $500,000 of long-term care, and they can choose a percentage. So for example, they may say, well, we'd like 2% a month. Well, 2% of $500,000 is $10,000 a month. So they could buy their $1 million life insurance policy. If it turns out that they need monies for long-term care because they can't do 2 out of the 6 activities of daily living, they will each receive $10,000 a month. Now, it does come off of the death benefit, but if you don't use the long-term care, your children get the $1 million. So the point is here's a way to create life insurance for your family, but at the same time, create the long-term care benefit. And what's the difference? If one policy was $10,000, by adding the rider, maybe it's $12,000. So it's a very interesting question that she posed, and there is specific answers to that we can help accommodate her needs.
Okay. And if I can just add, the premium differential between a long-term care and non-long-term care rider typically is somewhere between 5 and 10%. It's not even 20%. So you're talking about a relatively small difference. So that's one thing. The other factor to consider is since these long-term care policies of old had annual premiums that kept going up, if somebody was invested into their policy for 20 years and they were hit with a 40% increase, as was the case in many Florida policies for year after year, they couldn't afford to drop the policy because they paid in for 20 years, tens of thousands of dollars. They were stuck. They had to continue to bear the burden of that premium. But life insurance premiums don't increase in this same sense. So if we establish a policy, that policy is going to provide for them, and there's going to be a predictable outlay of monies and total peace of mind as it relates to the long-term care.
Gentlemen, thank you so much. Great information as always. And if you have a question, you can call the number on your screen or visit the website at any time. When it comes to your money and your retirement, it's important that you've considered all the options, including life insurance, annuities, and life settlements in your retirement planning. You've heard a lot of great information today, so why wait? Take what you learned today to help you live rich in the years to come. For Howard Kaye and Tony Scuderi and the team at Howard Kaye Insurance Agency, I'm Amy Sharp. We look forward to seeing you next time.